Happy New Year! Welcome back to the Dorian Finance Podcast, where we discuss finance, business, and much more. In this episode, our topics are how to buy stocks, retirement math, how to start a retirement account, index fund 101, high yield savings account 101. I'm your host, Dorian, and I'm thrilled to be your guide on your path to financial freedom. This is the first episode of 2024. Let's get started right by you following my podcast. How to buy stocks. Number one, you need to research, which you need to ask yourself quite a few questions. Where is the overall stock market at? Up or down, slow, stagnant, recession, etc. Then, what does the company make? The company that you're looking at buying. Are they profitable? Are they losing money? What level of risk can you handle? For example, say that your stock goes down by 50%. Would you keep it or sell it? I normally would sell my stocks if I can't see them going back up quickly, and also do a little bit of math. If a stock goes down 50%, it literally has to increase by 100% just to go back to even. And most companies don't do that. So that's just a little indicator. Next is you want to have a brokerage account. It's like opening up a checking account at a bank, but it is how you buy and sell stocks. I have two different ones that I use, and that will be in the show notes. And then you deposit funds, which you have to link your bank account to your brokerage account to deposit your money to start buying stocks. You select your stocks, choosing the stocks you want to buy based off of your research. Place a order. Your brokerage platform usually has two different options, a market order and a limit order. A limit order is you get to choose your price. A market order is you want to buy it right away. I have a whole video on that as well. Link in the show notes. Monitor and manage your portfolio, keeping track of your investments and adjusting your portfolio as needed. This is where your level of risk comes in. For example, I sold all my shares of GE after they went down by 50%, which I was debating whether or not to keep them because they had dividend and maybe they would go up, maybe they would just recover by just doing the dividends. But actually, it was a good thing that I sold all my shares because GE went down another 50% after I sold all my shares. Moving on to retirement math, and I made a full blog post and I've done a podcast about it as well. So you can go and look at that in show notes as well. But I find retiring has many problems, such as what are you going to do with your extra 40 hours plus per week? Do you have enough money to live off of? And many other factors. But it's really boredom, and also you don't have enough money to live off of. So this is the math portion, which is you're supposed to have 25 times your annual expenses. For example, if you have $100,000 of expenses per year, then you will need $2,500,000 to retire. This is where budgeting comes in play. This is where investing comes into play to allow you to make that money, and then you can use high yield savings account and other vehicles to safely recover money from your account so you can technically live off of it for any amount of time without going down in price. And also it's about budgeting during retirement because many people start overspending in retirement and cause themselves to need to go back to work because they overspent their funds. Other factors are taxes and fixed income sources. If you put your money into the stock market or other investments that have more risk factors, that could affect your retirement, that could do some damage, such as what if a pandemic happens and the whole market goes down by 50%? Your retirement just got hit by 50% if it's in the stock market, versus if you have enough money to retire, why risk it in the stock market at all? Use fixed income vehicles that don't have to be affected by the market too. And we're going to be talking about that too. Moving on to how to start a retirement account. First, determine your retirement goals. By determining how much money you'll need in retirement, think about other factors such as your current age, your desired retirement age, and your expected lifestyle and medical costs as well. What do you want to do in retirement? Watching TV gets boring really fast. Next is choosing the right retirement account. Common retirement accounts include 401k, Roth IRA, and even if you're self-employed, you can create a plan as well, retirement account. Each one has their own sets of advantages and disadvantages. And for the 401k and Roth IRA, I'll link in the show notes a full detail of what both of them, their advantages and disadvantages are. Also, take advantage of employer-sponsored plans. A lot of employers give out 401k plans and they match the contributions, which means essentially free money as long as you put your own money into it. Research investment options. Understand each investment options available to you within the retirement account. Some plans, it might not even be worth it to use because of how many limitations they have, and consider the risk tolerance you have and time horizon and your investment goals when selecting investments. Now, most of you who have employers, you'll be limited to whichever one the employer uses, but you can also select financial institutions if you're self-employed. Most of them are banks, credit unions, brokerage firms, and then there's some online platforms, two of them which I recommend. And then after that, you fill out the necessary paperwork, and then you can move on to setting up automatic contributions because it's more likely that you keep on doing it if you have your money come out of your account automatically versus manually. And then you, just like normal investing, you monitor and adjust, and you review your retirement account, adjust your contribution or investment strategy as needed. Many accounts have it where you do like 90% stocks, 10% bonds. As you get older, you want to be more conservative, which means more bonds or cash. And you can even put the cash in the high yield savings account to get a return on your money too. And lastly, stay informed about changes in tax law, contribution limits, and other regulations that may affect your retirement accounts. Index Fund 101. What is an index fund? Index fund is a statistical measure of the changes in a portfolio of stocks representing a portion of the overall market. Examples include the S&P 500, the Dow Jones Average. How do index funds work? Index funds passively manage their portfolios by holding the same stocks or bonds as the index they track. The goal is to copy the performance of the chosen index rather than trying to outperform it. And then indexes have a built-in diversification by holding a broad range of assets within the index. The diversification helps spread risk factors, reducing the impact of poor performers by any individual stock. Lower costs. Index funds have lower cost ratios compared to actively managed funds. Passive management. Index funds follow a passive investment strategy, meaning they don't rely on fund managers to buy and sell based on the market analytics. This strategy generally leads to lower turnover, which can be more tax efficiency. Popular indexes are the S&P 500, which represents the 500 of the largest publicly traded companies in the United States, and then the Dow Jones Industrial Average, which includes the 30 large publicly traded companies in the United States. The benefits of index funds is diversification, which spreads risk across many different assets. Low cost, typically lower fees compared to actively managed funds. Consistent performance matches the performance of the underlying index. Risk and considerations. Market risk. Index funds are not immune to market downturns. Tracking errors. The fund performance may deter slightly from the index due to tracking errors. No outperformance. Index funds will only match the market and will not outperform the market. How to invest? You can invest in index funds through brokerage accounts. Two of them that I refer into my show notes, retirement accounts or directly through the fund provider, and really just do a brokerage account unless you have really a lot of money. And then long-term investment. Index funds are considered suitable for long-term investors due to their passive nature, and historically index funds have only gone up over time in the stock market. Moving on to high yield savings account 101. High yield savings account is a type of savings account that offers a higher interest rate compared to a traditional savings account. These accounts are typically offered by online banks and financial institutions. Here's a basic overview of high yield savings account. Higher interest rate. I have my Capital One 360 performance savings with a annual percentage yield of 4.35% or APY. And that's a lot higher than the traditional savings account, which is not even a percent. Most of the time, it's online accessible. Many high yield savings accounts, you basically have a website or a mobile app and use ATMs to do most of your stuff. And just like a traditional savings account, a high yield savings account is FDIC insured up to $250,000 per depositor. Number 4 is no minimum balance required. High yield savings account often have no or low minimum balance requirements. You just have to look up which ones, what they offer and what they require. Easy access to your funds. A lot of high yield savings account allow you to access your funds through electric transfers, ACH transfers, or sometimes even ATMs. That's why I use my one, because I can easily transfer it to my bank account or even just straight up pay using the account without doing a transfer or waiting time. And then many high yield savings accounts have little or no fees, helping you keep more of your earned interest. Make sure to get one that has no fees. That's why I picked mine for no fees. And there's some that offer even higher amount, but then they sometimes have like a monthly maintenance fee or something like that. Mine doesn't. That's why I chose it, even though mine was a little bit less than I've seen some offer a 5.5%. And then the interest compounding. Interest is usually compounded on a monthly basis, meaning you earn interest on both your initial deposit and your interest that has already been added to your account. The purpose of a high yield savings account, you can use it for many different things, but I personally use it for my emergency fund so I can have that liquidity of having money on hand for emergency, but also still getting some sort of return on my dollar. You can also use it for short-term savings, useful for savings for a short-term goal like a vacation or down payment. Because it's a monthly rate, put it in for a month, get that interest, and then pay your bills. So you're getting a little bit on top of it. Factors to consider: interest rate compared to the interest rate offered of different banks. There's many different ones and different rates. Some of them are higher than others, but if they're really high, you have to look into their fee structure, check if they have any maintenance fees or transfer fees or lockout fees. Some of the high yield are actually really CDs or bonds that will have it where, oh, you can't even touch your money for like 30 days or something like that, or 90 days. I still want to have the flexibility of having funds available. That's why I chose mine. Please follow my podcast, and thank you for listening to the Dorian Finance Podcast.